Welcome to Stock Talk with Nico Criticos. Today we're going to be going over Expeditors stock, and this video is going to be dedicated to Jordan Lykowski because he works there. So as we can see here, Expeditors International of Washington is a global logistics company, and they offer freight or air freight, ocean freight, and ocean and customs brokerage services. So this is not a stock I've ever owned, but the past year has been very successful, or it was successful up until it hit about $135 a share. But the past couple months, it's come down a little bit, and now it's down to $97 a share. And this is a $16 billion company with a 1% dividend and a 11.7 current PE ratio. So if we use Nico stock market checklist, we can see that the first one is going to get a check because the stock is down significantly from its highs. And so that's going to get a yes. Then we have is revenue and net income increasing, and 2021 was a fantastic year for this company. They grew revenue from 9.5 billion in 2020 to 16.5 billion in 2021. Net income went from a little under 700 million to 1.4 billion dollars of net income in 2021. And the analysts have them doing a little bit of a decrease in both revenue and EPS for 2022. EPS is supposed to go from a year ago is 8.3. It's supposed to come to about 7. And then revenue is supposed to go from 16.5 to 16.3. And then next year, it's supposed to drop even more to about 13.7. So it looks like there's going to be a little bit of a slowdown for this company. They definitely have benefited from the huge demand in logistics services, like with the supply chain issues and everything. So both of those are going to get a yes. Then number 4, we have, do they have a healthy price to sales? I put yes, there's a price to sales of 1. And that one it's kind of in the middle somewhere because revenue is expected to fall. So the price of sales should be pretty cheap. And so that kind of makes sense. Price to earnings of, let's see. I like to use a forward price to earnings metric more than the trailing price to earnings. So forward price to earnings is a 13.5 roughly. And that's cheap, a lot cheaper than where it's been at in the past. But again, EPS is supposed to drop, so you have to consider that. So those are cheap metrics, but at the same time, their numbers are supposed to decrease over the next 2 years. So you're not getting anything that great. Are they innovative? Do they have a moat? I put no. I read through a lot of things. I read through their 10K. I read through Seeking Alpha articles. I read through their website. And really the conclusion I came to is just that they're pretty much just the middleman for, like, they pretty much buy up space from these, whether it's an airplane or whether it's a cargo ship, they buy up big areas of space to rent out to other businesses that normally wouldn't be able to afford that cargo space on the aircraft or whatever it is. So it's not like they're doing something that, I think it's a good business model. It's a great business model, but at the same time, it's nothing that they have like a huge competitive edge over. I think it'd be pretty easily replicable for another company to come in and do what they're doing. And so I really wouldn't call them innovative, and I really wouldn't say they have too big of a moat there. As far as the industry, I put yes, it is. I looked up the global logistics, transportation industry. It looks like it's supposed to grow at about 3% a year. So that is something. It's still, this isn't a business that's going away. There's people, or businesses are always going to need, cargo space and stuff like that. So that's good. Return on invested capital. This is definitely looks like a one-time thing. I put yes because it is 84%, but again, that's probably just that's more like an outlier because that probably happened in 2021 and 2021 only. But return on invested capital is 83%, which is extraordinarily high. Probably will not happen for a long time for this company. Margins, I put yes, they do have healthy margins. A profit margin of 9% is fine. That's healthy. Or 8.5% it looks like. And then gross margin of 27% is low, right? Because their business model, again, is just, they're pretty much just the middleman for other businesses that want to rent out transportation space or cargo space or transportation services. So that's why their gross margin is probably low, but it looks like they don't have a lot of, too many different costs in between there. So it comes out to 9%. which is fine. That's fine. That's a profitable business model. Healthy cash flow, yes. If we want to look closer into the cash flow statement, we can see here that operating cash flow has continuously grew over the last 4 years or so, and they've invested back into the business, not too small, not too big of an amount. Financing is, it looks fine to me. They're not taking out more than the operating cash flow is bigger than financing cash flow, so that's good. And then end cash position has gone from 900 million in 2018 to 1.7, so almost a double up there. That's excellent. And then free cash flow is, has gone from 500 million to over 800 million in the last 4 years, so that's good too. That looks healthy to me. Diverse revenue streams, I put yes, because they do have air freight, ocean, and a customs brokerage part of their business. It's split up very nicely. They're all like somewhere between 20 to, I think, 25 to 45%, pretty much all those three businesses. So it's pretty evenly split up, which is good. And then I put, because they do deal with so many various types of goods and different industries, that's also a way to diversify your revenue streams. And they operate globally. I think they operate in over 70 countries or something like that. So their business is spread out across, when it's a global business like that, and they're doing it in different types of industries, that helps diversify the business model. As far as the balance sheet, they do have more assets and liabilities, so that's good. If we want to look at the exact equity number, we can see here that as of December 31st, 2021, they have $3.5 billion of equity, which has grown nicely over the last couple of years. And we can see they have, sometimes I like to look at exactly where is the equity coming from, current assets or long-term assets. And in this case, they both look good there. So that's going to get a yes. Now this one I'm still experimenting with, this metric, a healthy price to book ratio divided by equity growth, or relative to equity growth. So equity growth over the past year grew 35%, right? And their price to book is a 5. So I'm still, experimenting to see and trying to graph out what exactly a healthy ratio looks like. But a 5 price to book is not horrible, especially for a company that is growing their equity 35%, right? So if the equity was only growing like 5 or 10%, well then yeah, I would expect the price to book to be like a 1 or a 2. But a price to book of 5, that it does demand a higher equity growth is needed. So they have strong equity growth, so a price to book of 5 is not totally ridiculous or anything. It's somewhere where it belongs. And then we have, is the equity over 10%? This is another newer one I added to this list, but is the equity over 10% of the market cap? And yes, it is. They have 21% of their market cap as the equity number. So again, they have, what do they have? 4 billion in equity, right? 4 billion in equity for a $16 billion company. So it's a quarter of it, which is healthy and strong, right? Sometimes if you get lucky, you'll get, it's very rare to find, but if a good sign of an undervalued company would be if the valuation of the company is trading what the equity is trading for. Sometimes you can find that. So I've even found times where the company's equity is actually higher than what the company's trading for as a whole. So, but normally that's not the case. Normally it's going to be like the company can trade for, 10 times or 15 times what they have in equity. But in this case, it's only trading at 4 times. But again, you're getting a company that is decreasing revenue and stuff. So is equity increasing? Yes. And then we have a strong share buyback or a dividend. Yes, they do have a dividend. Again, it's only 1%, but it is something. And the more important thing is the payout ratio, which here is only 14%, which is extremely healthy, which means they could definitely raise. Well, it's a payout ratio of 14%. Again, though, they had this outlier year where they made up the $16.5 billion of revenue. So normally, if revenue drops 10 or 20%, then that payout ratio is going to go up a lot. And so, but the bottom line is the payout ratio is extremely low. They can definitely afford to raise the dividend. Maybe they can have a 2.5 or 3.5% dividend if they really wanted to. And dividend growth is there at over 11%, so that's healthy too. As far as a share buyback program, the number of shares did go down as well, not by a lot, but still, they're still taking some shares off of the market, which is also helping out the stock price. So that's a good sign. And then we have number 17, are insiders interested? I put no. This was the only other one that they got a no for, because insiders own like 0.5% of the company. And I understand this is a huge company. $16 billion is a lot, but still, even for a company that size, we should still see, 5% to at least 5 or 10% of the company owned by insiders or executives. But that's not the case here. We have less than 1%. And not only that, but we have the insiders are not buying either. If we look at the last couple months, we can see here that, keep in mind, again, though, the stock price is up significantly from where it traded at in the past, right? If the executives were buying in these previous years at $70 or even $80, I don't know if it makes sense to be buying in 130 or, even now at 97, it's still up from where it was 2 years ago. So sometimes that could be the case. Maybe they just have enough shares or whatever, but there's really not much going on. You have, a little bit, I guess you had seven insider purchases back in January, but you also had 7 sells. So nothing too convincing there. You had a lot of buys in last April, right before it had its run. So that's interesting. But yeah, we can keep an eye out for what the insiders are doing, but as of now, there's not much convincing evidence there to show that this is a great time to buy the stock. So that's going to get a no. Finally, this one is more, it's a little bit subjective, and it's also just kind of like a point to bring up for you, the investor, to go and research the management and just kind of get familiar with their style and their track record. So I put, is it founder led? It's not founder led right now, because this is let's see, when did this company originate? Wait, where does it tell you? Oh, 1979. So 1979. So this is the executive team. And then I put, do they have good management or do they have a talented team? Well, see, that's a lot. Some of that is subjective and up for you to decide, but you can pretty much estimate that by, you can listen to interviews and watch how they talk and what their thought process is. You can see, are they making acquisitions? Or actually, they brought up in the 10K that, like, for example, they said their other competitors oftentimes will grow only because of the acquisitions and the mergers they make. And they're saying that Expeditors is different because they don't do that and they try to grow internally, which is interesting. That's great that they can do that, but I don't think I don't believe it's a negative for a company to grow by acquiring. That's how the biggest companies in the world do it. So that's not really a valid point, really. But you could check, things like return on invested capital is good. Things like seeing how the balance sheet is the stock price going up, and are they growing revenue and net income? Are they, what's it called? Are they going to other countries and are they expanding? And they pretty much have done all those things, because as you can see on the list, they've hit 16 out of these 18 things. So they've done everything that they need to do, right? And so in that case, it makes it look like management is good. But if you want to get if you're going to invest in the company, it's always good to just get familiar with the team, see what their style is, see what do they plan to do and stuff like that. So overall, I would actually consider this stock a buy for a 16 out of 18. That's very good. Once again, though, the stock price is not, I don't know if it's at a great price right now, right? Because I think it could come back down to this. I think it could come back down to $85 or $90, right? If it comes back down to $85, then maybe it would be interesting. Because look how long it traded at, right around this $70 point for years, pretty much from 2018 to 2020, it traded at 70 something dollars. So there's a good chance it could come down a little bit, and then maybe it would be interesting. It would be interesting buy. But as right now, I'm not interested. And also, I'm not a financial advisor, so try to make your own decisions here. But yeah, that is it for Expeditors International. And I will see you guys in the next video. If there's any stocks you want me to make a video on, comment down below and I will do that. But thank you for watching and have a good day.